Welcome back to Everything You Know About Trading is Wrong. I'm Tom Crown, and we're going to take a look at some complex trading concepts, but we're going to put them in terms that everyone can understand. Today's topic is RSI, or Relative Strength Index. This is an extremely common indicator used by professional traders around the world. This is a momentum indicator, also known as an oscillator, used in technical analysis to measure the magnitude of recent price changes. RSI gives us signals such as overbought or oversold conditions. The indicator can range from 0 to 100, above 70 indicating overbought, and below 30 indicating oversold. This indicator was originally developed by J. Wells Wilder Jr. and was introduced in 1976 in his book, New Concepts in Technical Trading Systems. Ever since, traders have been using this indicator to find a trading edge and to secure profit. To add RSI to your chart on TradingView, simply click on Indicators, type in RSI, you should see Relative Strength Index. Simply click it and it will be added to your chart. I like to make a few tweaks to it myself. You can do this by double-clicking anywhere on the RSI indicator. I'm not sure who chose this color scheme, but purple on purple is not my favorite. I like to click here next to RSI and make this white. For me, it allows RSI to stand out a little better on the chart. You'll also see this yellow squiggly line in addition to the white RSI line. This is a moving average of RSI. It's up to you if you want to use this or not. I personally don't, as I think it adds a little bit extra noise to the chart that isn't needed. The formula for RSI looks very confusing, and in reality is pretty confusing itself. But we can put this into simpler terms. Basically, what RSI looks at is the average gain or loss in a specified time period. So what does RSI tell you? Going back to the concept of overbought or oversold, RSI is an indicator that might tip you off that an investment has gotten a little too hot and overbought, or that the bears have been a little too zealous and the asset has become oversold. Now, it's important that you apply a time frame here. Overbought or oversold on a 1-minute chart might not be that useful. But when we look at daily, weekly, or monthly time periods, being overbought or oversold can be a significant indicator that you should pay attention to. We tend to look for something called divergence. Now, this concept I have made a video on before, but I wanted to put it in simpler terms. Because RSI is describing the upside and downside movements of an asset, we expect it to trend similarly to the chart candlesticks. When price moves up, so should RSI. When price moves down, RSI should follow. But divergence is a powerful trading tool. And so what makes divergence? When price and RSI aren't doing the same thing. So if an asset hits a new high, but RSI doesn't hit a new high, you have divergence. When price and RSI are doing the same thing, I've coined the term no divergence. This is when we're not really getting a signal from RSI. Divergence can be understood very simply. Any difference between price and RSI's movement is divergence. When that divergence is looking at your high swings, that is bearish divergence. When you're looking at low swings, that is bullish divergence. Important takeaway here, you cannot have bullish divergence on highs, and you cannot have bearish divergence on lows. So logically, RSI divergence is an indicator of a reversal of trend. It is not helpful when determining continuation. Another common use of RSI is something called a swing rejection. So what makes a swing rejection? When an asset is overbought and then begins to cool off, RSI falls back out of the overbought status, but then reverses and moves back again towards it. If it is unable to re-enter overbought and instead is rejected and moves lower, this is what we call a swing rejection. This is a powerful method of looking at the RSI indicator. So there you are, RSI. Go forth and trade like champions.